What we all need to know about pensions and annuities now, part 2. And now this leads us on to annuities. Annuities are essentially an insurance contract. You exchange your pension fund in return for an income. And once you buy an annuity, it's important to note there is no going back. You only have one chance to buy an annuity. You can take up to 25% of your pension plan as a lump sum and then purchase an annuity with the balance in your pension plan. You don't buy an annuity until your independent financial advisor has checked the whole market, and this is what's really important. Irrespective of who your pension plan has been with, you do not need to buy an annuity from them, and it's most important that you don't until you have shopped the market and used an independent financial advisor to do this. You are not obliged to purchase an annuity at the age of 75, which has been the case up until recently. So you can put off the moment of purchasing an annuity until you want one. So annuities calculation. So what we've been looking at earlier is annuity rate of £600 for 10,000, i.e. 6%. But annuities are calculated on an individual basis, and they will vary according to how investments have been performing, and unfortunately they have been dropping in value significantly over the last few years. They will take into account the age, so if you're going to be taking out your annuity at the age of 75 versus 65, your annuity rate will be much higher at 75, quite clearly, because your expected age that you will be living until your death will be less. So there will be less payout for the provider. They will also take into account your state of health, any hereditary diseases that might have been within your family, whether you are a smoker or a non-smoker, whether you're male or female. All these things will affect your annuity rate. But here we're saying it's £600. So what we can see here is that if you've got a pension plan value, when you come to cash in and purchase an annuity, then that £10,000 will actually buy you £600 annual pension. £100,000, a substantial sum of money, will buy you an annual pension of £6,000. So we can see that actually to get a decent sized pension, we need to have a very sizable pension plan. There are different types of annuities. So when you come to purchase an annuity, you have a number of choices. And one can buy a single life annuity, which if a husband bought a single life policy, it would mean that when he dies, his wife will no longer benefit from any pension, that pension scheme, from that annuity which has been set up. If there's a joint life annuity, then let's say it's the husband's pension plan and he's taken out a joint life policy, then assuming he dies before his wife, then his wife may benefit from, let's say, 50% of the monthly pension. So it's likely to be less, but at least she will benefit from having some pension. Rather than in the single life policy, she won't benefit from any benefits from the plan which her husband had taken out. A level annuity means that the level of pension payment will be consistent each month going forward. A guarantee annuity allows the person to guarantee annuity payment for a period of years, and this might be 5 years. So let's say a man took out a pension scheme, took out an annuity, and then dies after 1 year. The pension scheme will carry on paying out for 4 more years. So that will benefit, assuming there is a partner. Then there's a linking it to an RPI, the retail price index, inflation, so that as inflation increases, so your pension will increase in step with inflation. Or else you can look at an annuity which will increase by, let's say, 3% annually. But let's just sort of illustrate how this could look. And this is simply an example. We can see, assuming we're retiring at the age of 65, single life, a level scheme with no guarantee, we're looking at £6,400 in this example. Obviously, if we didn't take the pension out until 70, then we'd benefit from much higher pension. Similarly, if we started drawing out a pension earlier, at 55, we'd see that at £5,282. If we were to look at a guarantee of 5 years, then we see the pension has dropped, but at least we have that secure knowledge that we've got a guarantee for a 5-year period. Similarly, if we look at a single life with a 3% escalation with a 5-year guarantee, there again it's dropped now to £4,500. It's dropped by £2,000 per annum. Similarly, if we look at a joint life at 50%, so that assuming it's the husband scheme, then the wife would get 50% of the available pension. Then that would be £5,800. Or if we looked at a joint life with 50% payment for the partner, 3% escalation each year, with no guarantee, then that would be £4,000. So obviously the more conditions, ensuring safeguard against inflation, a joint life, guaranteed sum, this will reduce the annual pension. But it may be right for you as an individual. So this is where you certainly need good financial advice so that you can make an informed decision which is right for you. And this completes the brief introduction to pensions. And then if you download the tool from the Managemoney4life website, you'll be able to interact with these examples, and there's a huge amount more information available as well. Thank you.